Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Las Vegas Sands Corp. Annual Report. Las Vegas Sands Corp. offers a diverse range of businesses and services through its integrated resorts in Macau and Singapore. At the heart of these resorts are luxurious accommodations, including hotels such as the Venetian Macau Resort Hotel, the Londoner Macau, the Parisian Macau, the Plaza Macau, Four Seasons Hotel Macau, and the Sands Macau in Macau, as well as Marina Bay Sands in Singapore. In addition to accommodations, the company provides gaming facilities, entertainment options, retail malls, convention and exhibition spaces, celebrity chef restaurants, and other amenities. These integrated resorts cater to a wide range of customers, from leisure travelers seeking luxury experiences to business professionals attending conferences and exhibitions. By offering a comprehensive array of services under one roof, Las Vegas Sands Corp. Has established itself as a leading player in the hospitality and entertainment industry. The significant increase in Las Vegas Sands Corp. (LVS) stock price over the past year can be attributed to several key factors. One major contributor was the company's strong Q4 2025 earnings report, which exceeded expectations with an EPS of $0.85 and revenue of $3.65 billion. The exceptional performance of Marina Bay Sands in Singapore was a significant driver of this success, reporting a record $806 million in EBITDA for Q4 2025. In addition to the strong earnings report, Las Vegas Sands also increased its quarterly dividend to $0.30 per share from $0.25, signaling confidence in its financial health and profitability. Several analysts, including those from CBRE and Deutsche Bank, raised their price targets for LVS and maintained buy ratings following the financial results. The recovery and growth in gaming markets, particularly in Macau and Singapore, also played a significant role in the stock's increase. While concerns about Macau margins impacted the stock in early February 2026, the underlying strengthening of gaming volumes, hotel occupancy, and non-gaming activities throughout 2025 bolstered revenue and profitability. Overall, these factors combined to drive LVS stock price up by as much as 84.36% from its 52-week low in April 2025 to a 52-week high in December 2025, reaching $70.45. Las Vegas Sands Corp. Market capitalization of $40 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Las Vegas Sands Corp. Holds a significant advantage in their industry. Las Vegas Sands Corp. Trades at a higher price-to-earnings ratio of 25 times and a higher price-to-book ratio of 24.95 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 85% of total assets. This elevated debt level warrants heightened caution, as it may limit the company financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth in Macau's gaming industry can be attributed to several key factors. Firstly, the increase in visitation to Macau and the growth of Chinese outbound tourism market have contributed significantly to revenue growth. Additionally, the expansion of integrated resorts and casinos, as well as investments in property renovations such as Marina Bay Sands, have also driven revenue upwards. Furthermore, the introduction of new suites, rooms, and amenities at Marina Bay Sands has led to an increase in rooms revenue. The casino tax rate change from 5% to 8% for premium players and from 15% to 18% for mass market players has also had a positive impact on revenue growth. Attracting international visitors and conventions through the investment plan in Macau, as well as upgrading MICE and entertainment facilities, have further contributed to revenue growth. On the other hand, the primary drivers of revenue decline are higher sales and marketing costs, increased payroll costs due to a competitive environment, and decreased cash generated from operations. The payment for MBS purchase of the additional gaming area has also led to a decrease in cash generated from operations, resulting in a revenue decline. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it increased by 29% from $1,431 million to $1,866 million between 2023 and 2025. However, this growth was short-lived, as a decrease of $90 million in 2025 due to tax exemption in Macau offset some of the gains. Furthermore, a decrease of $181 million from $1,446 million to $1,627 million between 2024 and 2025 indicates that net income did not consistently increase. Profit margins also experienced changes during this period. The operating income margin decreased from 24.6% to 19.4% between 2022 and 2023, while the net income margin increased from 15.4% to 19.7% between 2021 and 2022. These contrasting trends suggest that profit margins were affected by various factors. The reasons behind these changes are multifaceted. The increase in ownership of SCL through share purchases contributed to an increase in net income, while changes in foreign operations may have also played a role. Conversely, tax exemption in Macau led to a decrease in net income. These conflicting statements highlight the complexity of the company's financial performance during this period. The company's financial performance is a testament to its ability to generate positive operating cash flow. Over the past 3 years, the company has consistently produced significant amounts of net cash from operating activities. In 2025, the company generated $3,023 million in net cash from operating activities, while in 2024 it was $3,204 million, and in 2023 it was $3,227 million. These figures demonstrate a strong ability to generate cash from its core operations, indicating that the company is financially stable and capable of meeting its obligations. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total liabilities of the company increased by 9.1% from $17,506 million in 2024 to $19,986 million in 2025. This increase is a result of both new borrowings and debt repayment. The net change in debt level shows that while there was an initial increase in debt in 2024, the company made significant repayments in 2025, resulting in a decrease of $1.86 billion. In terms of interest expenses, the data suggests that they have increased despite a slight decrease in interest expense, net of amounts capitalized, from -$746 million in 2025 to -$19 million less than 2024. However, this decrease is not significant enough to offset the overall increase in debt level and liabilities. Furthermore, the company's interest expenses have remained relatively stable across the 3 years, with a slight fluctuation due to changes in market rates. The data also highlights that the company has made efforts to reduce its debt burden through refinancing and debt repayment. However, the significant increase in total liabilities suggests that the company still faces challenges in managing its debt level. Overall, while there are some fluctuations in interest expenses, the company's debt level has increased significantly from 2024 to 2025. Management is optimistic about the company's long-term growth prospects, driven by economic expansion and increasing wealth in Asia. To capitalize on this trend, the company will focus on high-value tourism through its convention, trade show, and meeting facilities. The Pesa brand will play a crucial role in VIP gaming marketing. In addition to driving revenue growth, management is committed to sustainability across environmental, social, and governance priorities. This commitment extends to investments in Macau, where at least $4.47 billion will be allocated by 2032 for non-gaming projects. These initiatives aim to enhance the company's position as a leading developer and operator of integrated resorts through strategic objectives such as renovations and expansions. Furthermore, management plans to return excess capital to shareholders through share repurchases and dividends. The company is also investing in non-gaming projects, including entertainment shows, sporting events, culture, art, health, wellness, and themed attractions. These investments are aligned with Macau's evolving economic development strategies and will contribute to the city's growth. The company's expansion plans extend beyond Macau, with a focus on Singapore through the MBS expansion project. This project includes a hotel tower, rooftop attraction, and live entertainment arena, further solidifying the company's presence in the region. Overall, management's strategy is centered around driving revenue growth, enhancing shareholder value, and contributing to the economic development of Macau and Singapore. The company has made several strategic acquisitions and divestitures in recent years. In terms of acquisitions, the company has purchased additional gaming areas for SGD 1.13 billion, approximately $848 million. It also acquired a lease agreement with Nassau County for 72 acres of land, which will last for 42 years. Furthermore, the company leased the Marina Bay Sands on a 60-year basis and acquired the Las Vegas sale, although specific details are not provided. In addition to these acquisitions, the company has also made significant investments in other properties, including the Nassau Coliseum, which was purchased for $241 million in June 2023. These acquisitions demonstrate the company's commitment to expanding its gaming and entertainment offerings. On the other hand, the company has also divested certain assets, including VML subconcession on December 31, 2022, which reverted casinos and gaming areas back to the Macau government. The company will also be divesting its digital gaming activities by December 31, 2025, for $58 million. These divestitures suggest that the company is streamlining its operations and focusing on core business areas. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company resumed paying quarterly dividends in August 2023 after a 3-year suspension from April 2020 to July 2023. The declared dividend per common share is $0.30. In addition to dividend payments, the company has also engaged in significant share buyback activities. Notably, it redeemed $1.63 billion of outstanding principal amount of senior notes in 2025. Furthermore, a total of 8,144,631 million shares have been purchased under the program, with an approximate dollar value of $1,557 million remaining to be utilized. That concludes the financial summary for Las Vegas Sands Corp. Feel free to comment below, and I will be happy to answer them when possible.